What's good, people? Welcome back to another video. We got a lot to talk about today. Quite a lot of information to take in, quite a lot of price action to go over. Tomorrow I have school, so this is going to be a video dump, if you will. It's going to be probably at least an hour, if not like 40 good minutes. If you're not interested, please don't click this video. Go watch something else. This is going to be like a trade recap. It's going to be a kind of weekly sort of recap. I mean, we just started the week for us, but what we're expecting this week, the position I'm in currently, and our new hopefully better strategy that we've implemented today and will hopefully implement for the few weeks coming by. So how about we get right and started here. I can't remember what we did last video, but oh yeah, no, we did. I know what we did last video. We predicted where price would be and would get. So like I said in my Discord, if you guys aren't there, I would recommend joining. Sorry, the chart looks a little different. I was trying something else, but you can see here that this was from yesterday, Friday, and this was around almost 10. Yeah, almost 10. So it was late at night. And I was doing my analysis, okay? And this is what we realized, this is what we had. And the analysis was that we had created that swing high, swing low. We had that market structure shift all in the 1 hour. And we had marked out the standard deviation on the 1 hour. So here it looks kind of incredible that the -4 is all the way down here. And on the chart, it doesn't look like a lot. But when you really zoom out, we've like the price action has been running up bullish for weeks and weeks and weeks and weeks. And there's no way that in 2 days or in 1 day, we'd lose everything by just going down to the -4. And so I was like, okay, well, let me think about this, right? Because first of all, the standard deviation that is from this fair value gap, or yes, from this market structure shift, lines up with this weekly fair value gap. I don't know if you could see it's this basically. It's this blue fair value gap here, but it's like kind of grayish, like white. Anyways, the consequent encroachment of that fair value gap is here, and that consequent encroachment lines up to the dot with the -3 right here on the standard deviation. And what I like to do is I like to draw the mean threshold of this whole entire range. So it was from this swing low to that swing high, and the mean threshold, if we even do it again, I'm pretty sure is right here. That's the mean threshold. So right under that consequent encroachment of that fair value gap, see that gray line, that's the mean threshold of where we can start buying up again. So the whole plan, and I'm pretty sure I said this in my Discord. I don't know why it's maybe not, maybe it was here. Oh yeah, there was this one. Okay, so as you can see in this one, I had the mean threshold down here, and I had the standard deviation lined up with that. I had some sell side liquidity down here, and I had a hourly time frame bottom of that 1 hour fair value gap. Kind of changed my idea, became a 30-minute fair value gap because we've already traded into that 1 hour fair value gap, which I saw the consequent encroachment got taken out, and traded again through this I guess CPI day or whatever news day this was. Updated that, and then this was our prediction. So I either predicted that tomorrow morning we would either see this come up and inverse this fair value gap and take out those highs because we were so close to them, and then just run it up. But I think I had other choices, and I came with the realization that I was wrong with this inversion analysis. And what actually happened is when you draw the range of this, it's actually right now the price is in the premium. So that means that we can start selling. And we can start selling because there's a fair value gap here. And it wants that consequent encroachment. It might want to sweep that internal liquidity here of that at the top of the fair value gap and then kind of come down. And this is what I had noted here. Kind of sweeps this, comes down, comes down, comes down, comes down. There's liquidity down here to be hit. There's that -2.5 standard deviation that needs to be hit. Obviously, that weekly fair value gap can be hit. And right above it would be the consequent encroachment of that whole, daily range, hourly range, which would be a good thing to target if we want to start buying all the way up to the all-time highs. So what do we get at 8:05 when I wake up? The exact price action that I expected. The 4 hour, as you can see, went completely through the consequent encroachment. Boom, tapped into some kind of liquidity that was up here. and absolutely dumped in hours, right? And we came down under that fair value gap weekly, under the consequent encroachment of that. We fully closed under that, and we are almost to the consequent encroachment of that 30-minute fair value gap that was marked out in that 1 hour fair value gap up here, okay? Notice that when I woke up, we hadn't quite hit the -4 standard deviation, but looking at that, experience beats strategy every single time. So with the experience of the standard deviation, I know that if it gets near a point, it's going to want to take it out, okay? That's something that the market does. If it gets so close to it, that means it wants to take it out and it doesn't have enough power to do it. So it's going to retrace and come and get it, okay? So that's kind of what we got today. I don't know why I'm on the 4 hour. This is the 1 hour. As you can see, the 4 hour or the 1 hour came down, boom, almost hit that -4, which is that super big standard deviation right there. Sorry, we have a lot of stuff. I'll clean this up while we go in this video. Almost hits that that -4. Okay, and we kind of come in, boom, boom, boom. I'm pretty sure this is where we open, right? 9:30. We look right here. Yeah, 9:30 is right here. So 9:30 is a little wild. We do get some price action that opens up here, and then we come all the way up. We get that consequent encroachment of that fair value gap, that weekly fair value gap, which we just kind of chopped right through, and chop as in chopped like right through, not choppy price action. Just absolutely sliced through that, completely closed through that, and we came up to that consequent encroachment, started selling off, and then we come to that -4 standard deviation. And I also realized that there's another hourly market structure shift that happened during our run up here to that fair value gap. We do create that swing high, the swing low that creates that swing high, and then that creates that standard deviation that gives us those levels that line up almost perfectly with this low. What ends up happening is that this low gets swept with internal lows, and then it creates that move up. And so the play here, which I realized a little late, but it swept all this with internal. We had that 3 hour order block. I'll show you right here. Whoa, what the fuck just happened? 3 hour order block, which was right here. This is a bullish order block, as you can see, off the move it reacted. And so when you get to these order blocks, right, you're expecting some kind of reaction. I don't usually target the consequent encroachment of these order blocks. I just kind of like to see where price is in general when it hits these kind of order blocks. But as you can see, didn't even need to come down to the consequent encroachment here. It touched once, touched twice. This dotted line is that second standard deviation from that second market structure shift that we had. So we have this little standard deviation zone that's created here. We're also completely out of that 30-minute fair value gap, which is right here, right? Boom, we get in, consequent encroachment, kind of trade in, choppiness, boom. Market opens around here. You can see taps into that, absolutely dumps all the way down, and we close under that 30 market structure or 30 market fair value gap. So we can delete this fair value gap because that was one PD array, one liquidity, internal liquidity. We have that 3 hour order block, right, which at the time wasn't marked on my chart. What was only marked was this line here with that -4. Okay, that was the lowest point I'll go to take the trade. You can see that price action reacted with a doji, and that's actually what my strategy, or the strategy that I'm building and back testing right now and forward testing, is teaching. So basically, you want to have like a set trend or set order flow in place. You want to identify where price could be going and wants to go. So in this case, it went down, right? We're bearish order flow. You can see it's making higher highs and then lower highs, and then it's making lower highs, lower lows, and then it creates that lower low, and then that lower low completely takes us out here on the 5 minute. So what happened? Oh wait, no, my bad. Yeah, so it makes a higher, yeah, my bad. Hold on, I'm tripping. Makes a lower high, or lower low, higher high, or lower high, my bad. Then that lower high makes a lower high, And then that lower high makes off that fair value gap here, a higher low, or a lower high. Then that swing high here makes a lower low, and that lower low creates a lower high. Wait a minute. Am I tripping? Okay, I don't know why I blinked out so hard there. What I meant to say, I'm pretty sure, was that we were in this range, right? So you have these highs up here, okay, that are created, and we're on the 1 minute here. I really don't like the 1 minute, but it is where it is. It's where I took my trade. So you got these highs, and then you have the lows that are created. And what I saw was, like, even on the 1 minute, we had that, shoot, where is it? This. We had the -4 standard deviation that was there, right? That was our level. That was the last level I wanted to see hit. We had that our 3 order block that was there, and we had some internal liquidity, which was right here, which I'll mark out for you guys right here, which was also swept by price too, okay? So after I saw this swing low being made, right, we created that little range up here that made that swing high on the 1 minute, okay? And in my mind, this is still in the range, right? We are still in, like, I hate drawing trend lines, but we're like in this range, right, of like going downwards, okay? And so now, in a way, we're waiting for that high to be taken out to then go higher, right? And the strategy itself is basically like the OT, basically what I was teaching. Basically what I was doing is we wait for that market structure shift to happen, and then we wait for retracement, but instead of drawing the OTE, we just target anything that's under the consequent encroachment or above the consequent encroachment. So in this scenario, we have a high time frame PD rate, we have another high time frame PD rate, we have internal liquidity that gets swept, we have that standard deviation that gets swept, we have our internal bias that is also there due to it not wanting to go lower, and it does show that it does not want to go lower. And if it wants to go higher, then we will see it go higher. And if it wants to go higher, it will target obviously that high here because it's above that consequent encroachment, and we want to target that. But if it wants to target anything higher, we draw the standard deviation and we target the -2.5, which you'll see actually lines up perfectly with the weekly fair value gap here. You can see I'm not making this up. The standard deviation here, literally here, right, from that swing low to that little swing high, literally lines up with that -2.5 in that weekly fair value gap. Okay, so that's our area to target. Area to target is this up here, right here. That's our area to target, right? So with that being said, what I did was, and in what I'm gonna explain in the strategy is you wait for this high to be broken. So it gets broken right here on that candle, closure above that candle. Yes, we're doing this on 1 minute. It's a very tactile strategy. It's very fast. That's why I use 2 monitors, and I have like 2 time frames on each monitor. So I have 4 time frames. One time frame is the 1 minute, 5 minute, 3 minute, and then 15 minute, right? And what I like to do and what I like to see is when this range is created for that market structure shift or that 1 minute market structure shift, I like to see the range. And so what you do is you mark your discount or premium, right? So when we do, you have that swing low to that swing high. If we do premium discount, right, you can see that the consequent encroachment of this tiny little range is that red bar right here, okay? And that right here, anything under is when we can start buying. So on the 1 minute here, because I'm already on the time frame, do I see any fair value gaps? No. Do I see any order blocks? There's this little tiny order block here that is there that I marked out, but we're looking for fair value gaps. So here, do I need to see anything? No. Do I see any inversion fair value gaps? No. This is all choppiness. There's no, I don't want to look for order blocks here because it looks like they just get taken out and there's no clean move. Okay, so 3 minute is the next option. Whoops. So 3 minute is our next best option. Do we see any fair value gaps that are being created here? Yes. We have this high and that low. That's a fair value gap that gets marked right here. Okay, and note where it is, because when I go back to the 1 minute, that fair value gap here is only created because of this low right here on 1103. And when I go back to the 3 minute, that low is created at 1103. So that very last candle creates that fair value gap for us right there. And that's important. That's extremely important, because what happens next, and even if we keep going up to the 5 minute, right, do we notice anything? 5 minute, no. 5 minute is just a doji, and then a big candle up, which is good price action. So we go back to the 1 minute, we have that 3 minute fair value gap that we had marked out. That's the only kind of price action resistance that we have. So if this doesn't work, it doesn't work, it will reverse. And we could all use this as a inversion fair value gap. The only thing I don't like to do is there's nowhere to target except that, you know, to fill in that that 3 hour order block. The thing is, it's, to me, it's not enough risk to reward to even target this, right? Because the risk, I really don't like it. I don't like this trade if you were to inverse. So there's not enough leg room for me, right? So what I did was mean threshold, premium discount. We're under that mean threshold, so that means that we can buy in that green area. We see that there's a 3 minute fair value gap that gets created there. 1 minute, you can see that it comes down after creating that swing low. It creates that swing low or swing high right here with this closure of this down selling pressure candle, and then that second candle on 1106, we get that tap into that 1 minute fair value gap. You'd enter at the top. In the strategy with this, and this is why I love it so much, is we're not going to target the consequent encroachment. We're going to target the top, because we're going to get in as early as possible, because what it likes to do, and like what price likes to do on the 1 minute, as you can see, it doesn't quite come down to the consequent encroachment. You might see it on the 5 minute where it has more time to develop the candle, right? But on the 1 minute, it's literally 50 seconds or 60 seconds, but those first 10 seconds go by like crazy. It has literally 60 seconds to make it down, up, down, up, down, up, whatever it needs to do. It will not, trust me, it will not all the time hit the consequent encroachment. Hence why I like to get early and put my stop loss either super tight or like you did, or like here at the range low. If I had a little bit more money, right, I would have been putting my stop at least maybe up here. Or if I had less money and I was risking less, or if I was just risking the same amount, maybe my stop would be down here at these lows. Right? Again, this is the set stop loss, but my mental stop loss is way bigger than that. Okay? Now, with that being said, when you have your entry, you're targeting the negative 2.5, -2, because it's a low risk trade. And the fact with this is, I want you to remember, we're on the 1 minute. So the 1 minute isn't likely to move the whole hour time frame. Okay? That's one thing to understand. It is very hard to catch trades that start the trend of the whole trend, right? If you caught, let's say, this trend right here, this trade, that's very good for you, right? On the 1 minute, that's very, very good. Like that's very good. But it is very unlikely for us to do that with our strategy, because we're targeting a 1 minute like buy order right here, and it's very time specific. It requires you to be on the market right here, right now, accepting that there's a 3 minute fair value gap, 1 minute order block, this and that, and you got to decide when to buy, when to sell. You have to understand how the market moves, because here you know obviously there was a bearish order flow, but when it's pressuring like this, you're not thinking of going long until it reacts off some kind of PD array. And you can see that we had those internal sweeps here. So that's one side of buy side liquidity. Then we have that standard deviation, which isn't actually liquidity. This isn't like a level. It is a level, but it's not liquidity. There's no price, there's no orders being placed there. It's just there at the end of this move. It's telling us that this is the last possible leg of this market structure shift, right? So that's the last, like, okay, I'm done, price is done. That's why I started consolidating around there. So that plus that 3-hour order block, which didn't even want to come down to the consequent encroachment, that shows us 3 sides of bullish patterns that get created. Obviously, if you're looking and you have experience, you could see that there was that that swing high made. You can also see that there was this displacement made, and you can probably, off that swing high, you can easily tell that this is above the mean threshold. You could probably say that this fair value gap here was helping price move down into this. And then you could do the same. You could go, okay, where's the mean threshold here? Oh, it's under here. So now you see how price does. It comes under that mean, or above that mean threshold, so it starts selling. Then in this tiny range that we created, it comes under, so it starts buying again. So it starts buying, create that range, we enter, right, off displacement. You could actually enter probably off here, off this fair value gap, into closer moves, probably here. I don't know where it is. Probably not, actually. Very tight. Yes, it wouldn't work there, but that's the idea. So when you do your analysis right, you can see that, yes, price gets rejected here, but then you have your mean threshold, and you can do the exact same on the opposite idea. If your bias is right, your order flow is right, your analysis is right, you'll see that price moves in your way. The only problem is, how do you catch it? What I like to do is I like to think that every time we go lower, we have to go higher, even in that 1 minute time frame. Once that high is created, it wants to go back lower to grab some kind of internal liquidity, which would be that 1 minute fair value gap, which is what we're targeting, and not quite the OT, right? If I showed you here and we made that OT present, we would only be so far from entering, right? So the OT is there. We would want to see that price come down, and it doesn't do that, but it does come down to that fair value gap. So a little unfortunate, but that was that, right? I'm going to do both because I have, I don't know why, but I have trouble finding these market structure shifts, especially in these market conditions. You know, it's the new year, it's the first day after New Year, so obviously price is going to be a little choppy, a little fucked up. But yeah, so yeah, let's just see what happens after. So we have our trade here that runs up to the negative 2.5. That's our target, right? Nice, 3-to-1 risk to reward. Very clean trade. We come up, we hit that fair value gap to the dot. We sweep that external fair value gap right here with those wicks, and we continue higher. We continue higher, but where? Oh yeah, look at this tick. You see that tick? It's gray, so I know it might be hard to see, but see this line right here that's kind of dotted? That actually is the mean threshold, or the consequent encroachment of that swing high and that swing low. That's the halfway point right there, that little crossy line. That means that if we're above, we can start selling, and if we're under, we're buying, right? So right now we're all under, so anything under this we're buying. We can start buying, we can buy. Now, unfortunately, what we did not do is we did not use this fair value gap as a inverse fair value gap, okay? And I was kind of hoping for that. What I didn't realize was this 15-minute fair value gap, which was being used for a move lower, okay? And what actually happened was it touched that consequent encroachment too, but look where the body closes of those candles are. It is right under that consequent encroachment of this 15-minute fair value gap. You can see here the wick, boom, boom, fair value gap nicely right almost in the middle of that consequent encroachment of that whole range, hence why I marked it. And it used it, tapped almost into that premium area, sold off, and you can see that it sold off even with an even larger volume, because that candle ended up being bigger than that buying, and you can see it just kind of started selling off. We had that fair value gap typed in, institutional order flow around 130, boom, and it starts dumping at 145, dumping. And this is actually where I made the mistake. So for my first initial bias of the day, like I was saying, the first trade idea and trade bias that we had was identifying this market structure shift here and applying it to the charts. And so what I had before, and this is going to get real messy, but we have this down move. Okay, we have this hit on that -4, right? At first I didn't have that hourly order block, and I was like, whoa, okay, well, we're making new highs, you know, it's going off. Pretty sure I was watching this live go up. I'm like, all right, this is gonna work. And so basically what I had intended was that this high would be used as a market structure shift, or even this one. This one made more sense on the 15-minute. And you can see that this high creates a swing low, then that swing low creates that swing high creates that swing low, and that swing low actually demolishes all of those highs up here, and it closes all the way up here. So the thought was, okay, well, these highs got broken. Okay, so boom. That means that there's a market structure shift there. Okay, which one do we take? Now, usually, right, this is a downwards trend where we're making higher highs, lower lows, then lower low, lower high, lower high, lower low. So this is obviously bearish. It's bearish. What we like to do is target this one because this is the highest higher high, even though this is a bearish order flow and a bearish trend. So we like to do that, and we would like to see this broken to see a market structure shift, and that's what happened here. So we can delete this one. And so when I draw my standard deviation from that swing low to that swing high, you can see that the -4 almost hits that all-time high. So I'm like, all right, right away, I'm like, all right, this is going to work. This is the trade that we want to take. And so what's next? What does our strategy teach us? Well, we say that swing low to whatever swing high we make, and we draw the OTE. So that's what we did. So swing low to that swing high, we draw the OTE and we drag it out, right? And so we wait, and so we did. So obviously, as you guys saw from that fair value gap, we do get a reaction off of it. We come down. As you notice, that gray line is the consequent encroachment of that range. We go right under it, so we start buying up a little bit, buying up enough to come into this fair value gap to dump it all back again. And as you can see, this is why I want to switch strategies, because this completely got railed through, and it did have an impact for one candle, and it just got completely artward. So unfortunately that happened, right? And we learned from our mistakes. I think it's because the move itself, obviously it was off. We want to see this swing low created off a high time frame PD array, an internal sweep of liquidity, which in a way we got, yes, and we also had standard deviation there to help us with that, which I thought was perfect, right? Because we did have that perfect nice move up right in there. Just didn't see that fair value gap. Also just didn't see that we had swept that fair value gap on the weekly. Honestly thought we were going higher, and I thought that could be it, but you know, you have to be real with yourself, because to be honest, it comes down here at 2:15, so we have 2 hours left to go back up and to make this trade at least valuable over time, because if you remember, we were targeting the -2.5 in any strategy, and you can see that in 2 hours that will not do it. So I think I don't think that this is, to be honest, here's what I'm thinking. If you're still watching, okay, and you're thinking this dude's a loser, he does not know what he's talking about, I think there's a reason why this didn't work. So yes, it was valid. It was a pretty big market structure shift. It did happen. But results, look at this. Market structure shift happened. What do you expect? You expect price to go higher, but you also expect a retracement. What you do not expect, and what you should not see, is a retracement so big that it sweeps your market structure shift low or high. So as you can see, that's the market structure shift here. That's the high that I made. And so the range is that, the OT is there. So you're hoping that the retracement is only almost halfway through, gets to the OT and retraces all the way back and expands higher. The only problem is if we're targeting the -2.5 standard deviation tool, it is not enough and it is too big of a range to be targeting. Way too big. You see here on the 1 minute, on the 5 minute here, you can see this range, this little tiny range we had for that 2.5 or 3.5 risk to reward. That range is small. It's very small. It's easily targetable. But this is like days worth of trading, days worth of moving up and down. This is not a 2-hour trade where you can get in at 1 hour and at the second hour you can take it off. That's my first mistake, where I didn't realize how big the range was, right? It's a little unethical to enter here and to target 2.5 already. You know, it's a little high to do that. Okay, that's the first thing. The second is, yes, we did hit that liquidity, but it wasn't really fully validated, right? On the 15 minute, so it happened on the 5 minute, 15 minute, you can see, is there really a market structure shift that happens, right? This is all wicking. So I don't like wicks. I prefer body full closures, but swing high, higher high, we make a lower high, or lower high, lower low. That lower low then creates a lower high. That lower high then creates a lower low. That lower low breaks through that lower high and creates a market structure shift here. So in this case, standard deviation would now be moved here because that's valid on the 15 minute. Where's that negative 2.5? Up to that consequent encroachment. But that's still such a big ass range. And the range itself here on the OT still remains the same. Swing low to swing high, right? Still remains the same. Breaker structure, that's valid, but it did not hit the OT and did not bounce off like we wanted to. It actually broke. So that's part of the reality. So next time I take one of these trades, I need to put in my notes how big the range is, okay? Because the range itself also tells you how big the move will be, right? Obviously, this is not valid anymore because the low was broken through. So that means that it, in a way, reversed on us and that it was not, you know, it couldn't play out anymore because we would be stopped out already. So the other factor is that I'm focusing on the big, like these are big time frames. Like the 15 minute is big, especially even if you're trying to target those low, like those low standard deviation numbers. Like look where the -1 is. Like that's far. Usually -1 is like right above the high. Like I'll show you on the 1 minute where we took that that trade. Usually the -1 is like, where do we do this? Where was it? Right here. -1 is like right above these highs, man. It's like, it's right there. It's right there with you. You know, it's not super, super far. It's right there. Right. So it's important to have those levels to be, oh yeah, and look at this. The -4 is almost like straight at the fair value gap. So that's definitely a target for us to target now. But standard deviation helps knowing where your target is, right? Because the -2.5 is basically halfway through to that long play here. And if truly, if you're targeting that -4, which I don't know why you would do that on such a low or a high risk trade, to be honest, that would be dumb because you have that 1 minute market structure shift. That's fine, but you don't have these higher time frame market structure shift quite yet. So why hold a long position for so long, targeting so high, if you don't even know if the higher time frames are going to be on the same page as you are on the 1 minute? That's another problem that I need to fix. Another problem, I think, to be honest, let's just agree, there's so much shit on my chart, I cannot even understand what's going on. Like, I look like a newbie with like 400 fucking lines here, fucking drawings here, and then there's a trend line up here, and then there's this going through it, and there's this right here. Like, it just looks like that right now. Like, that's what it looks like. And I need to fix that because so much standard deviation, so many fair value gaps. I just need to clean it up, come up with a better chart, come back better than ever tomorrow. Real quick, I just want to make sure that we go over the strategy that was in place. So this was the first one. This is in my Discord if you guys want it, if you guys want to use it. But this is the same thing. Just have a monthly, weekly, daily bias on the market. You can read that. Mark out Asian, London, New York session highs. That should be all-time thing. I don't know why I don't have the indicator. I guess it disappeared, but I need to get it again. Asian, London, and New York session highs. So Asian and London, usually it's London lows and London highs that get targeted the most. That's usually good. Obviously, in this case scenario, you could see that with this dump, the London lows and everything were created like in between or even pre-market here, so it really didn't make a big effect. But usually when it consolidates and gets in those low ranges, we do have those London lows playing a big part. Identifying the current trend. So like I said, like this can go from the 1 minute all the way down to the 5 minute, and you take your entry on the 1 minute. You can read all this. You can pause whenever. And I still need to like forward test this, so it's not fully done. I still need to trade with it and see how it works. But so far the concept should be relatively not new to you guys because I've already talked about it. But the concept should be very simple. It should be just a move up into some kind of PD array that happens, right? Move up or down, right? I'm just gonna do move up now, and this move up hits that time frame, and then that move up breaks the low that it has created here. And in that displacement, there is a fair value gap here. And there is the consequent encroachment, which is mean threshold. Okay, so that fair value gap is up here. There's that mean threshold. The price, oh shit. Price breaks through mean threshold right here. Okay, you have that 1 minute fair value gap or order block that's there, and price will want to retrace and will retrace above that consequent encroachment mean threshold into the discount or premium of that range, hit that fair value gap, and then what it'll do is after this retracement, it will then break not only this low but this low, so it'll even go higher, lower. And what you can do now is you can draw the standard deviation from this to here, and you can get the exact part of where price will target. Okay, so that's the model. That in itself is the model, and in itself too, when it's the exact same thing, but we are just not using the OTE. And instead of the OTE, or you can see the OTE actually hit perfectly here, but instead of the OTE, we're using PD arrays that are created, or inefficiencies that are created on the lower time frames. Usually the OTE does not work on the lower time frames, and that's because it is a little too precise. Those levels are not always hit to the dot on the 1 minute, and the fair value gaps or order blocks have a bigger zone, have a bigger gap where price can fill exactly where it wants, and you can see exactly how price action reacts and how you want to enter. And you can enter right at the top, right at the bottom, and you can see that your stop loss either gets hit right away or it kind of comes up, and you can target these kind of areas, -2.5, -2, and get away with profit. And listen, right now, if price were to do like I just showed you, were to go up, and yes, it comes down a little bit, but it comes up, it hits that -1, or that 1. So first of all, right there, you are risk-free from there. That means you can move your stop to break even, okay? You can move your break even to even higher. And that means that by the time you have your first take profit, you're risk-free. You've made profit, right? And so then price can come down, break even, and you've made $100 or $50 or $5, but you haven't lost anything. So you're risk-free there. So that hits. And if you're break even, which it doesn't come down, and it comes down all the way to -2, boom, you're double risk free. Now, if it comes to -1, your stop is there, boom, you're done. You made $200 or $2 or $10, right? You're done. And then -2.5, obviously you head to the tick, boom, bam, you're done. You're done for the day. You step away. Okay. So again, that's a strategy. That's what I'm trying to teach. And that's what I'm trying to, not teach. That's what I'm trying to learn right now and forward test this. So I will see you guys in the next video. Tomorrow I have school, so I don't know if I'll be able to trade this week. We'll see. But what I like is that I have some kind of strategy down that I'm looking at, and I have some kind of idea of what I want to be looking at. I think the biggest lesson here is the standard deviation. I'm just in love with this because standard deviation tells you exactly where price will go and want to go. And I think that you can look at the ranges, and the smaller it is, the more probable price is going to hit those. So as you can see, this market structure shift here wouldn't be so valid because the range itself is so big. But if you look on the 1 hour, you can see that even on the 1 hour, it's in a way it's valid because the 1 hour is such a big time frame. It can take its time, right? But if you're on the 15-minute and your standard deviation is looking like this, that might be a little problem. That's a problem, right? But the 1 hour, as you can see, there's no market structure shift, so there's no need for standard deviation. So I'll see you guys in the next video, and I hope you guys have a good one.